What's up, Investomaniacs? Knight Rider here, and today, we're talking about how the FTC and DOJ are reportedly both considering taking enforcement antitrust actions on large technology companies. These governing agencies have the capability to sue, fine, and break up companies which they believe are a monopoly. The Department of Justice is taking a look at Apple and Google, while the Federal Trade Commission is checking out Facebook and Amazon. While liberals have, relatively speaking, always been more in favor of breaking up larger companies, historically the conservatives have fought back. However, things are different this time around, as the new era of large tech companies are known for being extremely liberal-leaning and in some cases trying to suppress conservative voices. So now you have both sides of the parties considering breaking up some of these massive tech companies. Google, Facebook, and Amazon all fell several percent on the news. Google and Facebook in particular have consistently been accused of silencing conservative voices. In the past, the government generally wouldn't step in to break up a company until it began raising prices to an unreasonable level to consumers. But things, again, are different this time. Facebook and Google are absolutely free, or at least you can use a lot of their products absolutely free. Amazon is often the cheapest reputable place to buy almost anything. Similarly, companies can find much better bang for their advertising buck on platforms like Facebook and Google compared to traditional advertising methods. So, why are these companies being looked into by the DOJ and FTC? It is no longer about pricing. Now, it's all about power. Google and Facebook alone control nearly 60% of all advertising on the internet. Liberals say that's too much control over the marketplace, and they can inhibit the growth of new advertising companies. But liberals and conservatives are concerned over the potential abuse of these automated systems in regard to influencing voters in elections, as was the case with Facebook. That means regulation and or a breakup may be coming. If either of those happened, it would be bad for shareholders. Apple's CEO Tim Cook stated, quote, "Our share is much more modest. We don't have a dominant position in any market." This is likely true when it comes to smartphone sales. The primary concern is not necessarily that, but the aggressive 30% commission for every app sold on Apple's App Store. However, the App Store only represents about 5% of Apple's revenue. Morgan Stanley analyst Katie Huberty calculates even if Apple were forced to reduce its commission from 30% to a much more reasonable, say 15%, it would only impact the value of the overall company by about 7%. All in all, not horrible, even for a potentially worst-case outcome. While Google has a large chunk of the search engine market, Facebook and Amazon have established themselves as significant competition in the past few years. Plus, although Google controls 42% of internet advertising only represents 41% of overall advertising dollars. So Google only controls 17% of the overall advertising market. That doesn't exactly sound like a monopoly, right? But again, it's somewhat subjective depending upon how you view it. What about Amazon? Clearly, Amazon must be a monopoly, right? Well, when you actually look at the numbers, not exactly. eMarketer estimates Amazon represents 37% of US internet sales last year, but only 3.5% of total retail sales. Heck, Amazon doesn't even do half of the sales that Walmart does. And you don't hear anyone running around saying, Walmart's a monopoly. Some politicians said that Amazon was putting small companies out of business by offering their own private label products. But those private label products only represent 1% of Amazon's revenue. Plus, many large retailers have their own private label line. My kitchen is full of Walmart's great value private label food. So are you going to end all private label? No. Now let's talk about Facebook. Facebook has had a lot of issues over the past couple years. Facebook has consistently handled user data in an aggressive manner that politicians don't like. That won't result in a breakup, but it could result in regulation and/or a big fine. Facebook has already set aside $3 billion to cover a potential fine from the FTC. Some believe Facebook has too much control over internet advertising and may be forced to spin off Instagram. Rosenblatt securities analyst Mark Zudowick calculates that this may cause roughly a 10% decrease in overall shareholder value due to operational disruptions. While these are worrying times, history will show us antitrust cases are not successful very often. The DOJ recently failed to block AT&T's acquisition of Time Warner, and its antitrust case against Microsoft failed, and Microsoft arguably had more justification than Facebook, Google, Amazon, or Apple to be broken up. So should you worry about a breakup? If you're a long-term investor and you're already in these stocks and you have a gain, I don't really think these concerns are large enough to justify selling them and absorbing the capital gains tax. However, if you're not in these stocks, hey man, you might want to put your money somewhere where the skies are a little bit bluer. However, if these stocks take a significant hit due to antitrust concerns, we'll probably want to revisit them and see, hey, is this something we should be afraid of, or is this actually a buying opportunity? Hey, hope you guys have a great day, and may the market be forever in your favor.